All right, good evening. Let's take this all off. Good evening and welcome. So, today's video will be on liquidity and imbalances. So, we'll be discussing the concepts of liquidity. What is liquidity and what is imbalance? And this concept of liquidity and imbalances, it is what this is how smart money traders view price. Smart money traders go into a body of price action to only look for liquidity in price and imbalances where there is pockets of imbalances. So let's begin. So what is liquidity in trading? So if you as you can see, the there are swing highs in every there are swing highs and swing lows every time the market changes direction. So for example, this right here is a swing low. This low is lower than this low here and this other low. This is a swing low. This is also a swing low. A swing low is a swing point in price action is a for example, in referencing a swing low is a low that has both higher lows at its side. So you see this low here, that's this low here, which is higher than this low and this other low. The same thing with this. This is a swing low. This low and this low, they are both higher than this low. So this right here is a swing low. Same for this. This is a swing low. This and this. And inversely, you have swing highs. This is a swing high here because you have two lows, two candle lows below and beside them. So a swing point consists of three candles. The first candle, let's use this. A swing point for a swing high consists of three candles. This candle here, and a higher candle, and a higher candle, and then another lower candle at its side. So this is the swing high. This point right here is the swing high. Inversely, you have the swing low. And this swing highs and swing low, this is where traders generally put their stop loss. They put their stop loss at this swing point. So this is a swing low. That's two higher highs at its side. So this is a swing low. And when they are trading, they'll put their stop losses on top of this swing point, either the swing highs or at the swing lows. So this is what is called liquidity. Liquidities are already pending orders that are already resting in the marketplace that smart money traders use to facilitate their entry or their exit. So that is liquidity. That is the basic form of what liquidity is. And we have two types of liquidity. You have the buy side liquidity and you have the sell side liquidity. The buy side liquidity are buy stops that traders place on the market. So, and you do not need you do not need an indicator or anything to look for buy side liquidity or sell side liquidity. Just take every swing highs, you label that as your buy side liquidity. You can do this also as you watch this video if you can bring up a chart while you do this because it's better for you to learn it on your own. So So the swing highs, every swing highs, you have buy side liquidity resting on top of those highs. So you have buy side liquidity here, and you have buy side liquidity. Let's use the swing highs for reference sake. This swing high is here. So we're using this swing point, this swing point, and this swing point. This is buy side liquidity because it's a form of its liquidity resting above the marketplace, above the current market price. That is buy side liquidity. And inversely, you have sell side liquidity. Sell side liquidity is a form of liquidity resting below the marketplace. So yeah, this is a swing low because it has two higher highs, higher lows above it. Sorry, beside it. So yeah, you have, let's make this red. So yeah, you call it the sell side liquidity. And what are sell side liquidities? So sell side liquidity is market orders, sorry, are pending orders that are already resting in the marketplace. And these orders that are pending orders, when price trades to it, it will become a market order. Currently, they are pending orders. All form of liquidities are pending orders in the marketplace. These pending orders, we as smart money traders, we are only interested in these forms of orders, in liquidities and imbalances. But for now, we're talking about liquidity. So these orders that are already pending in the marketplace, smart money traders will use it to facilitate their entry. So if they are going long, say they want to go long, they will go long from after the sell side liquidity has been purged. When the form of sell side liquidity has been purged or swept, they will pair their orders. Smart money traders will pair in their buy orders with that sell side liquidity that is already resting in price. So, and inversely, when they want to go short, when smart money traders want to go short, when price trades above a pool of buy side liquidity, they will use that buy stops orders that are resting here, that are pending orders. They will use it to facilitate their sell orders, their market sell orders, to act as a counterparty for that buy stops, that buy side liquidity that has been resting there. So the buy stops order are called buy side liquidity, and the sell stops order are called sell side liquidity. So this is the basic form of what liquidity is in the marketplace, and you do not need a form of indicator to see it. So this is the buy side liquidity resting in the marketplace. This is the weekly time frame, but the time frame currently does not matter when you're looking for liquidities. Price is price in every time frame. The difference is just that when you're when you're having when you're looking the weekly time frame, it takes longer time to form compared to when you're looking at the 1 minute time frame. So let's take this all off. And secondly, we have the imbalances. So what are imbalances in relation to price action? So Michael typically uses the paint analogy. Most of the analogy that comes to my head right now is fleeting. So let's just use the analogy that Michael uses, and it is as clear as possible. So if you've ever painted your house or a smooth flat surface or a wall, when you dip your roller inside the paint bucket and you apply the paint upward, there will be pockets of places in that where your roller has just currently rolled. There will be pockets of unfilled paint where the paint didn't sufficiently deliver inside of those pockets. Let's say you paint up. So all of this inside of this place where the where you where your ruler went higher, there are pockets of walls, pocket of spaces that the pens didn't deliver efficiently inside of. So later when you dip your roller inside your pens back, you will come back to those you will come back to those on field where the pen didn't deliver efficiently. You come back there to make that smooth, to have a smoother delivery of paint on that wall. So that's an analog to how imbalances are in the marketplace. So let's take a look at this price action. So when this swing high was established here, when the swing highs was established here, price broke downwards here. Use the paint analogy in your mind's eye to look at price like this. So when price traded downwards here, traded up to fill this the pocket of price action here. So you had price traded back down lower and created when price traded back down lower, it left this imbalances, this unfilled price action here. So here you note this as an imbalance. So price left an imbalance here. So this is an imbalance on the sell side. So price is lacking in buy side. So we expect price to come back up to fill this imbalance, this pocket of price action that has not been filled, to make this price range here, to make this range between this low of this candle and the high of this candle, to make it a balanced range. So imbalances are left in price action when price makes a quick and sudden one-sided, not sudden, sorry, a quick one-sided move to a direction. There are forms of imbalances. There are hierarchies of imbalances, but we'll discuss that further when while we progress further into this mentorship. So, as smart money traders, we are only interested in liquidities and imbalances. When you note these liquidities and imbalances, you will see the market clearer. The underlying narrative on how this market is booked will be revealed to you clearer, because that is what smart money traders look for in price action. They only look for liquidity and imbalances. So more on imbalances. As you can see, when price traded up here, there was no imbalance here apart from this imbalance that we have here. This imbalance now is a breakaway gap. This is indicating that price is eager to come to this liquidity. So when an imbalance is left unfilled like this, when you have an imbalance that is left unfilled, there will be criteria and narrative that will build into when you expect a pool of imbalance to be filled. Price does one of two things: either to trade back into an imbalance to fill an imbalance in price action, or to go for a pool of liquidity, either buy side liquidity or sell side liquidity. Think of imbalance. An imbalance consists of three candles. An imbalance consists of three candles, which is you have one candle at its side here. You have one candle at its side here. Then you have another candle that trades lower, using a bearish imbalance for reference. So you have a candle that trades lower here, and you have the third candle that trades like this. So inside of these three candles, this the low of this candle and the high of the third candle, that is, you let's call this candle number one. This is candlestick number one, and this is candlestick number two. This is candlestick number two, where the imbalance, where we had that speed in price action that drives price lower. Then the candle number three does not trade to the low of the candle number one. So this is we call this the candle number three. When the high of the candle number three does not trade to the low of the candle number one, you have an imbalance in price action. So let's label this red. So you have an imbalance in price action. So the imbalance consists of three candlesticks, where the candle number three does not the high of the candle number three, this is for a bearish imbalance, where the high of candle number three does not trade to the low of candle number one. So you expect at a future time in price to make this, because now this is an imbalance, to make this a balance, to balance this imbalance, we expect price at a future time to trade back up into this imbalance here. We do not know when this will occur. We just expect price to trade back up here. And the narrative in play in that, with your daily bias and the where you expect the weekly candle to draw towards to, will give you a clear view on when this move will be expected to go back up to balance this imbalance. And there are forms of imbalances. They have two basic forms of imbalances: the buy side imbalance and the sell side imbalance. The buy side imbalance is also called a BC. So when you have an up close candle that forms an imbalance, that is called a BC. BISI. Note this in your journal because this is valuable to understand price action. So when you call the BC, let's label this blue. So you have a BC. What is a BC? A BC is buy side imbalance and sell side inefficiency. Inefficiency. What does this mean in respect to a BC? So a BC means buy side imbalance and sell side inefficient. That means you have price delivering to the buy side and lacking in the sell side delivery. So so when price is lacking in sell side delivery, when you expect price to trade to balance that BC, you are expecting price to deliver sell side because it has offered buy side delivery and it is lacking in sell side. The sell side price is inefficient in sell side. Does that make sense? The buy side, the imbalance was created to the buy side because you have a one directional move, energetic upward, which left this pocket of price action. This is the candle number one, this is the candle number two, and this is the candle number three. And as you can see, the candle number three is low. to the high of the candle number one does not overlap, and this is what creates this imbalance. So price offered buy side delivery and it is lacking in sell side delivery. So when you note a BC and you expect price to trade back down inside of that BC, you are expecting price to deliver to offer sell side delivery. That means you are expecting lower prices. You are expecting price to trade lower into that buy side imbalance to balance to deliver the sell side delivery, to have the sell side delivery, because for a for a range of price action to be a balanced price action, it must offer both sell side delivery and buy side delivery. So inversely, you have the CB. You have what is called the CB. So the CB is an imbalance on the sell side. A CB is sell side imbalance, buy side inefficiency. So you label this, let's make this red. Sell side imbalance, buy side inefficiency. Buy side inefficiency. So a CB, everything we just talk about the BC, you inverse that for the CB. The BC is an imbalance to the buy side, while the CB is an imbalance to the sell side, which is lacking in buy side delivery. Sell side, the imbalance is created in the sell side for the CB. The imbalance has been created to the sell side, while price is lacking in buy side delivery. Buy side is inefficient. Now you expect at when a swing point has been established and you expect price to offer to balance this imbalance, this sell side imbalance, you will be expecting buy side delivery of price. Buy side delivery meaning you are expecting higher prices, because the CB, this CB here, which is an imbalance, it is lacking in buy side delivery. And as we just established earlier, price needs to offer both sell side delivery and buy side delivery to have a balanced price range. Think of the market as a chaotic, orderly environment. And as trader, our job as price action traders is to balance this imbalance, is to make beauty where there is chaos. You make beauty by balancing every imbalances and using resting orders that are already resting in the marketplace to facilitate your entry or your exit. So you do not enter the marketplace to force your will on the marketplace. You use the already resting orders, the already resting imbalances to facilitate your moves. Does that make sense? So that is the basic form of that is the basic understanding of liquidities and imbalances. This will be very vital in understanding the next video that I'll make after this. The next video will be about um, market structure. And market structure, before you understand market structure, you must understand the basic form of liquidity and imbalances, because market structure from a smart money perspective, it is not as the general public view market structure as higher lows and lower highs and stuff like that. We do not view market structure as in that sense. We view market structure in how has price gone to balance this set of imbalances, and how has price trade to its liquidity, how has that liquidity, how has it been used to facilitate smart money's entry and exit? How has it been used? That will give you the market structure, either if it's a bullish market structure or a bearish market structure. But we'll go more deeper into that in the next installment of this mentorship. All right. So hope you got something from this video and have a nice day.